Vetiva Capital Management has put out a report, H2 Outlook, which is titled after a movie, No Country for Old Policies. It's titled after No Country for Old Men, actually, is what the title of that report is. So joining us to take a look at a number of economic metrics in that report is Luke Ofojebe, who is the head of research at Vetiva Capital. Good morning to you, Luke. Thank you so much for joining us. Really appreciate you. Luke Ofojebe, who's joining us right now from Vetiva. I want to start, of course, with yield trajectory from your report. Can you take us through, I think you had a comment on the yield trajectory. That's yields, of course, fixed income yields in Nigeria. Hopefully we'll put that up to take a look at that chart. Give us your take, I guess, on what's in that report and the trajectory of yields for fixed income.
Good morning, Rotus. Thank you for having me today on your show. So speaking on our expectations for the yield curve, since the start of the year, we've been seeing an upward movement in yields generally, and that shouldn't be surprising given inflation levels in the country. Currently, headline inflation is around 18%. Food inflation is already over 20%. So if the CBN does not revert back to the traditional means of controlling inflation rates in the country, then it's likely that things could just get out of hand. That we might see food inflation rising to as high as 25%. And that will be counterintuitive to the CBN's expansionary stance on the economy. And that's why we've seen the CBN increasing rates so far since the start of the year. In the second half of the year, we expect to see more of that as well, but not at the pace we've seen so far, especially in the first half of the year. So in the second half, we expect to see rates rising up as well, given the fact that inflation levels are still at very high levels. And let's not forget that we are still seeing pressures on foreign reserves, given the fact that we still have some importers, mounting pressures on FX rates in the parallel markets due to restrictions on FX at the official market. So because of these concerns, we expect to see interest rates rising in the second half of the year. So we expect the yield curve to still show a parallel upward movement in the second half of the year.
All right, well, that's going to put, we're going to get to stocks in a moment. That's going to put more pressure on stocks, which is down about 5.8% year to date. The bond index compared to the all-share index, I think you've got a chart where you've compared both. What's happening there with bonds?
So really, if you look at the two curves, just that the image is a bit faint here, but you can see clearly that the bond index is actually underperforming the ASI index. And the reason for this is because of the inverse relationship between price and yield. So when yields are rising, then prices will be dropping. That's the common relationship between yields and bonds in the bond market. So, and because we've been seeing an increase in rates in the fixed income markets, so what that means is that prices of bond will be dropping consequently. And that's why that particular bond index is underperforming the ASI.
Great. So just for our viewers, the darker line above is the stock exchange all-share index, and the lighter line below is the bond index. All right. You're optimistic about FX liquidity based on the recent move by the central bank to on its website, it updated the NAFEX rates. Please expand further on how you think liquidity will be improved going forward.
Prior to now, we all understand that we used to have multiple exchange rates, especially at the start of 2020. However, in due to the economic downturn we witnessed last year, we saw a couple of devaluations and also the shift in FX rates. We saw the CBN moving the then official rates from 360 to 379, and now the official rate is now the rates available in the parallel market. So what this means is that it has helped to reduce the multiple rates to just two major rates right now. So we have what we have at the NAFEX window, which is now the parallel market rate. So these has helped to reduce concerns around which one should foreign investors be focusing on. So based on that, we should expect to see improved liquidity. However, we do not think that impact on the Nigerian financial markets will be very significant, given that there are still concerns that we might see possible devaluation going forward, given the widespread between the official rates and the NAFEX rates. Currently, NAFEX rates, the dollar is trading at around 412 naira, while in the parallel market is around 500 naira. So because of this widespread, so investors are still worried that we might see another devaluation that might take the NAFEX rate closer to the rates in the parallel market. So because of that, the positive impact we should see from narrowing the multiple rates to just two rates could be diluted by the fact that we still have concerns around possible devaluation.
All right, thank you for that, Luke. I think we've got a chart here: Treasury bills and bonds. This is still part of your narrative of there it is, yeah, and they're both climbing. So I think if you want to help us out, what you were saying earlier, I think this chart supports it. As far as the yield, so you're still seeing the trajectory of yields going up for Treasury bills and bonds.
Yes, clearly. For us at Vetiva, we still expect rates to rise in the second half of the year. But like I said, the pace at which these rates will rise will be much slower than what we saw in the first half of the year, given the fact that the CBN is still pro-growth, still wants to induce growth via low rates in the economy. So on that basis, we expect to see the pace of increase slowing down in the second half of the year.
Great stuff. There's also, let's now talk about what this means for the equities market, because it looks like there's going to be facing some pressure. I think we also have a chart, if we take a look at your stock chart here, where offshore index, like I said, down by 5.8% or so. So that pressure, as yields continue to go up, we see that pressure, I guess, telling on the stock exchange.
Yes, clearly. I mean, towards the end of the year, we saw an interesting rally in the equity markets, and that was driven by the fact that investors started diverting liquidity from the fixed income market to the equity market. So during that period last year, I mean, because of the economic downturn, CBN, like other central banks all over the world, decided to cut rates significantly in order to support economic recovery. So because of the low rates we had in the fixed income markets as at that time, the incentive to invest in the fixed income market dropped significantly. And that's why a number of investors, especially the institutional investors like PFAs, decided to play more in the equity market. And that was what led to the 40% return we saw in the equity market. But so far, year to date, I mean, it's been the opposite, really, compared to what you can find in other developing economies. If you go to West Africa, the Ghanaian market has returned about 40%. If you go to East Africa, the Kenyan market has returned about 13%. South Africa has returned about 12%. But here in Nigeria, it's already down about 5%. And that's because we are now seeing a reversal in terms of liquidity movement. So equity investors right now are diverting their funds to the fixed income markets, given the fact that rates are rising. And there is also that expectation that in the second half of the year, we are going to see further rate increases. So because of that, we are seeing institutional investors mainly this time around leaving the equity markets to take advantage of the rising yields we can find in the fixed income market. And so going forward, you expect that to continue to weigh on Nigerian stocks.
Does that create a buying opportunity? Because I think you mentioned other markets. So I think you also have a comparison to Nigeria's peers. Does that now create, in a minute, if you can, does that create a buying opportunity then? If you compare Nigeria to her peers, how the various exchanges are performing?
Yes, it does, really. So when you look at the market PE relative to its peers, it's much lower. So definitely it creates a buying opportunity. But we need to understand the fact that foreign investors, given what they experienced last year, a number of them, at the start of the pandemic, a number of them wanted to exit the country. But because of CBN controls around capital flights, they got stranded. So right now, they are still worried about FX concerns. Are we going to see another devaluation before the end of the year? And because of these concerns, foreign participation in the Nigerian equity market has dropped significantly. And that's why we are not really seeing any material upward movements in the equity market. So while we understand that a number of these companies listed on the Nigerian Stock Exchange currently have strong fundamentals backing them. I mean, when you look at Flour Mill's recent results, you can see the significant growth we saw in the top line and bottom line. And we expect that trend to be maintained in the second half of the year. But despite these strong fundamentals, we do not expect to see foreign investors coming in because of foreign concern.
Great stuff. Luke Ofojebe, Head of Research at Vetiva Capital, thank you so much for taking us through your report. We really appreciate your insights.